All right. There we go. And we are live on Facebook and LinkedIn and YouTube. So we are live all across our social media platforms. And we have a few people starting to join in. And we will monitor the comment section here. So I am going to type a test over here.
Make sure we're streaming on your MySpace page, please.
Yep, we are also streaming on my MySpace page. I have
a lot of activity over there.
I have 3 viewers there. So we are streaming there. I got a test in the chat. So we've got a few viewers on StreamYard here for our monthly live webinar for real estate agent training. And again, for those of you joining us on our social media platforms, follow us on the Ross Group on Facebook, the Rob Ross Group on Instagram, and Rob Ross Mortgage on X. And you can see those at the top of the overlay here on the screen. With us today, I have the usual suspects. I have Mr. Chris Carney, live from Bethesda, Maryland. I have Mr. Alec Gagne, live from Aldie, Virginia. Not to be confused with Stone Ridge or Ashburn, but Loudoun County, Aldie, Virginia. And we are going to get started for our live realtor training for the month of March. Hard to believe. It's March 19th. Hard to believe St. Patty's Day came and went. Might have been a little blurry with some extracurricular activity. We do see a few other folks have joined us here. So just a quick recap for another 30 seconds. This is the Ross Group over at Intercoastal Mortgage. We have live webinars monthly for real estate agent partners. If you're joining us here, you've hit our StreamYard link and you are joining us via StreamYard, but this is also being broadcasted on Facebook, on the Ross Group at Intercoastal's page. This is being broadcasted on YouTube and also on LinkedIn. Go ahead and follow us and subscribe on all of our social media outlets. We are bringing this to you monthly because we believe in partnerships and we believe in education and we believe in educating all of our realtor partners, whether we're working with you now or we might run across you in the future. We've been doing this a long time as a team. And with that being said, I'm going to kick us off and give you a little background on us, give you a few agent tips that might help you win some more deals. And then I'm going to kick it over to Alec Gagne for a few agent tips. And then we're going to bring it home with Chris Carney and saving the best for last there. Chris is amped today. So again, we're excited to do this for you monthly. Please spread the word and please do not hesitate to ask questions in the comment chat. And the 3 of us will be monitoring that and responding over there. So without further ado, let's get started. And if you see me do this, this is not a White Claw. This is a Celsius, very similar can size. But we're gonna not drink before noon today. We're gonna try that. All right. Where do we lend? Why is this important? It's very important. If you're working with different clients, you might have someone moving to the DMV area where we're located. But they're moving from California, they're moving from Las Vegas, Arizona, somewhere else that you see highlighted here on the map, and they need some sort of special loan or bridge loan or something that can help accommodate them into getting into their new home here where you are licensed. So just remember, these are the states we're licensed in. It's a lot of continuing ed annually, but this is where we can help you out. Again, myself, Rob Ross, I'm Executive Vice President here at Intercoastal Mortgage. Chris Carney, Alec Gagne, Senior Loan Officers, Chairman Club winners, part of the Ross Group here at Intercoastal, and Loan Officers Extraordinaire, and so much more. Claire Fleming, she hates the term mother hen, so we're gonna have to come up with something next time. But Claire Fleming is the glue that keeps us together. She's our team transaction manager. She's been with us 11 years. Simply the best. Can't say enough about Claire. So we appreciate Claire on a daily basis. And we're going to go through just in general, there's a few of Intercoastal's finance solutions. We're not going to go through all these today, just to give you a heads up to plan your day. This might be about 30 minutes today. This is going to be a little quicker webinar. But some of the things we're going to go through today, we aren't going to go through all of these. But we do have bridge loans. We do have portfolio and non-QM loans. We're going to touch on non-QM. We are experts in construction loans and bridge loans. We will not be talking about construction and bridge loans today. Those are separate full trainings for real estate agents coming up later in the year. So do not miss those. Conventional FHA, VA, USDA, jumbo, fixed and arms, 2-1 seller buy downs, down payment assistance programs of all types. And we're not going to go through those today either. But right now, just a sneak peek, we have a $15,000 grant that's available here in April. So if your clients qualify for that, we will let you know. Vacation homes, investment properties. Gotta love those vacation homes. I know I love my personal one up in Deep Creek Lake, Maryland. If anyone on here is looking to buy in that area, I've got some great connections and an amazing partnership up there. Investment properties, we did a pre-approval, Alec, this morning for a second home or maybe an investment property in Ocean City. So let's see here, 203K renovation loan. That is going to be a separate training this year. HELOCs and second trusts. Yes, 5 to 9 units, new to Intercoastal. Historically, 1 to 4 unit is considered residential. Anything 5 and up is considered commercial. We can now handle DSCR loans with 5 to 9 units. Chris Carney will talk about that later, talk about the DSCR loan later in this webinar. Non-warrantable condos, we are the condo kings. There's no one close. We've no condos. We live and breathe condo projects. We've closed out over 80 condo projects. It says 72 there. We're shortchanging ourselves. We've done over 80 condo projects. Anything you need, and that is a separate training, by the way. So a condo training is a whole separate training we're going to have. Last but not least, 9-day closings. Yes, 8, 9, 10-day closings. If you need to win the deal, if you need to get to closing, if you need to potentially beat out a cash offer because you're just a better offer, a 9-day closing is pretty quick. So, and we will move on to the next slide here. How do you follow up with the Ross Group? Just to give you an idea of our follow-up, if you have a client that needs help, we're going to call them immediately. Like, give us the name and phone number. We will call them immediately. The only way we won't call them immediately is if you don't give us the phone number, because we can't call. So we love if you do give us the phone numbers. We promise we don't bite. We're going to make your clients feel very comfortable. We immediately enter them into our CRM system where those clients will be the white glove service throughout the process. We'll follow up with them. We will call, text, and email clients about 3 times. We will follow up a ton of times over 7 days before we put them in some sort of long-term nurture campaign. Basically, what we're saying is if you refer a client to us, we're going to get them on the phone and we're going to make them happy and make them feel comfortable and educate them. That's our job. That's why we're here with you today. We are educators. So if you ever have a client say they haven't heard from us, shame on that client. They've heard from us. They're just, not getting back to us. Once the pre-approval is complete, we will send the client a very detailed information, and we will send you, the realtor or our business partner, a very detailed information on that pre-approval. And then they're going to get enrolled in our pre-approved follow-up for a home campaign. So they're going to get emails and text and phone calls from us throughout the process over 6 months. We hope you get them under contract in 1 weekend. But we're going to follow up with them for 6 straight months just to make sure they know they're taken care of. That's our follow-up process. Let's get into the real meat and potatoes of today's webinar. And we're going to go through a few agent or realtor challenges that we see here. And a few of you on here have seen this presentation before. We appreciate that you're back on here. A refresher never hurts, okay? Let's go. Agent challenge. You're writing a contract offer and you are going to ask for a seller credit. It's late, very late at night, maybe midnight. We know you work late. And you can't remember what the max allowable contribution is. Well, how are we going to help you here? Boom. That's how we're going to help you. We just blew your mind, other than the fact that you can't read limits under the graph there. So we're going to fix that next time. But seller concession limits. And we have a chart and we have a breakdown to the right. I'm not going to read through all this to you, but I'm going to go through a few highlights here. And if you drop your name and email into the comment section and you would like a copy of this, we will email you a PDF copy so you have these seller concessions readily available. Conventional limits, just so you know, you can go up to 6%. If your down payment is between 10 and 25%, you're really capped at 3 when it's below that 10% mark. FHA, you can get up to 6%. VA, you can get up to 6%. Actually, sorry, 4% on VA. And USDA, the seller can contribute up to 6%. So lots of different options there. One thing to remember that a lot of folks forget is for an investment property, you're capped at, what is it, Chris? 2%, right? So 2% for an investment property, unless you're doing a DSCR loan, which I've come to learn you're actually capped at 6%, I believe, for a DSCR loan.
Stay tuned for that one.
Yeah, stay tuned for that one. So a lot of good info there for you. We can get you this chart and you can keep this right on your desk. So when you're writing an offer at 11 p.m. for your clients, you can do that.
Before you proceed, with VA loans, one thing that no one really realizes is when you actually exceed the 4% rule, you can eat into the additional seller subsidy and pay off the client's debt. So that's the one loan product where if you exceed the seller subsidy in terms of closing costs and prepayment or prepaids and escrows, that excess can be used to pay down a credit card, to pay down an auto loan. I mean, I've used it 100 times and it's amazing.
Perfect. Exactly. And it's hard to see the VA loan there because of the little overlay on this webinar. So we will tidy that up for the next one, but I promise you the VA loan stuff's on there as well. We will go to the next slide. We're going to talk a little bit here about basically alternative lending solutions from ICM, and we're going to call it the non-QM difference. Non-QM means non-qualified mortgage. That doesn't mean bad mortgage. That doesn't mean subprime mortgage. That just means non-qualified mortgage. Basically something that Fannie Mae or Freddie Mac is not purchasing. Okay. Non-QM characteristics. Let's talk about a few things that will be not red flags, because they're not red flags for this program. They might be red flags for conventional loans, but for non-QM, they're characteristics, right? They're going to stand out. So when you as a real estate agent are talking to your clients, if they're telling you, because we know these clients divulge a lot to you, the real estate agent, they're talking about their personal lives. They're talking about all the reasons why they're buying a new home. They're talking about all this stuff. They might say, hey, I know my debt's kind of tight and someone told me I have a high debt ratio. I ran my own numbers, and they might start talking to you about some of this stuff. When you hear these buzzwords and these things they're talking about that sound like it might be a challenge, know that non-QM can fill the void for a lot of these type of challenges. Okay. Expanded ratios, 50% debt to income ratios, even maybe up to a 55. No private mortgage insurance on a lot of non-QM loans. We can accept many flexible income sources, which I will personally talk about next on the next couple slides. There are some 40-year term options, which is crazy. You might not want to do it. You might want to do it. That's up to the client, but we'll show you those options. Manual underwriting. We do not need what's called a DU or LP approval for these type of loans. That's desktop underwriter or loan prospector. We do not need these national automated approval systems. We can get these loans through manual underwriting. Some of the pros: enables buyers with lower credit to qualify for a mortgage. Less stringent income documentation, right? Application process is nearly identical, though, to a qualifying mortgage. Some of the cons, and I'll tell you, they are cons, but they're positives when it's your only option. Okay. Interest rates might be a little higher for a non-QM loan. And I need to take that maybe a little higher. They're higher, right? Non-QM loans are a little higher in interest rate. And we're not talking if a traditional loan is 6.5%, we're not saying a non-QM loan is 15.5%. We're saying it's 8 or high 7s, right? It might be a percent and a half higher. It's not that astronomical of a difference. Okay. Non-QM loans can be more difficult to find. Well, not with the Ross Group and Intercoastal. We have 3 to 4 different outlets for non-QM loans that we can help you with. And again, they're not sold to Fannie Freddie. These are private investors that are purchasing these type of loans. Non-QM expansion, man, it's really taken off. And I have a chart here next over the years, and we'll go through that chart. But there's a big number of entrepreneurs and small business owners that have skyrocketed over the past really 10 years. And a lot of those folks have very creative accountants, we're going to call it. And that creative accounting might help them from a tax standpoint, which is wonderful, but it does not help them from a qualifying for a mortgage standpoint. But we have a solution for you. We have a few solutions for you. A lot of originators meaning loan officers, are adopting these type of programs, right? So we're learning these daily. Non-QM supports borrowers that are underserved by the traditional mortgage industry, but no more. We've been doing these for about 4 or 5 years now, so we are continuing to evolve and become better experts with these programs. Let's keep going here. Just to give you an idea, really new non-QM hit the scene in 2016. And as you can see, it is really skyrocketed. 2024 just killed it, right? It was actually a little bit above that chart because that was a projection. But 2023, 2024 is really killing it. 2025, I can tell you this, we're not even a quarter of the way through the year. I guess we're getting close, but non-QM is in our daily vocabulary right now as a team. So it seems like every day we are talking about it. We are qualifying clients for it. So it is something you as a real estate agent need to be aware of and not be scared of. Agent challenge number 2. So number 1 was the seller concessions. Let's talk about number 2. Your client owns a limo service and has 3 years in the business. He or she does have 2 years tax returns, both business and personal, but he writes off almost everything. However, his asset statement showed deposits. What can you do for this person? Well, this person has a name. This person's a personal friend of mine, which is why it's an example. This person happens to be a real estate agent and owns a limo service, but a really great guy and a great professional who we've helped personally with a mortgage. We have helped them through this next solution. What is a bank statement program? It's all about the bank statements. It's all about the deposits, okay? Right at the bottom there. The bank statement program allows self-employed borrowers and small business owners an alternative method. Let me just break it down real simple for you. What we will ask of your clients when they apply, and we know we need a bank statement loan, we keep this super simple on the front end on the pre-approval. We have them send us 12 months bank statements or 24 months bank statements. They have the option. Why do they have the option, you might ask? Well, let me tell you. If they have 24 months bank statements, they can get a little bit lower interest rate than if they only have 12 months bank statements. And you might be asking yourself, well, why wouldn't they have 24 months bank statements? They can just go print it off of their Capital One bank account. Well, you can, but what if you've only had the business for 12 months? Okay. So you might have only owned the limo service for 12 months. Well, guess what? We can help you. Traditionally, you can't unless you're self-employed 2 years or more. But with a 12 or 24 month bank statement, you're sending us your bank statements where all your deposits are going for your limo service. So when you shuttle a group of people to an event on your limo bus for a weekend and you get $3,000 for that weekend, you get a deposit for $3,000. We don't care that on your tax return that $3,000 looks like $300 because of all the deductions and the gas and the maintenance and the wear and tear on the limo and so forth, depreciation, all that stuff, right? We don't care about that. What we care about is the fact that that was a $3,000 deposit. And then next week you had a $2,000 deposit. And then next week you had a $1,000 deposit. Here's the beautiful thing. We get those bank statements. We, being Claire, the amazing Claire Fleming, will upload those to a portal through our investor. And within 24 hours, max, worst case, within 24 hours, that investor's coming back to us and they're saying, hey, Rob, Chris, Alec, here's the income you can use for this buyer. And they're just using the deposits. They're not hitting them for the fact that, they wrote a bunch of stuff off, right? So that's a positive thing. And that can help a lot of folks that own their own businesses. So that is the bank statement program. I probably touched on a lot of it here on this next slide. Chris, you got something?
A question that I have gotten in the past here is, okay, Rob, if I need a bank statement, can I still do a lightning quick closing in 9-10 days?
No. So unless Chris or Alec want to argue me on that one. So you would not want to do a lightning quick closing in 9 or 10 days. I would tell you we're going to shoot for 25 to 30 days. we're probably going to ask you for 45, right? These are non-delegated loans, which means we originate. Alec, Chris, our group is we're your point of contact for your client. We're helping your client. We originate these loans. We process those loans. Claire Fleming, our transaction manager, Bambi, our processor, we process, we originate. We have the investor underwrite the loan. Now, the investors have a 48-hour turn time on underwriting, so it's super fast. But these loans do have a lot of moving parts. These loans don't have a backup plan in many cases, right? So mortgage lenders won't tell you this. We're in the business of selling loans, not owning loans. When we obtain loans, we like to sell off into the secondary market. We like to sell to Fannie Freddie. We don't want to hold those loans, right? Maybe that's a whole different class someday. But what I'll tell you is we do get these closed in 25, 30 days. That would be the time frame. So let's see here. So we will go, and I'm not going to read all these again. 12, 24 months, incomes calculated within 24 hours. These can be used for owner occupied, second homes, or investment properties. That's awesome. Loan amounts between 100,000 and 3 million. That's amazing. 1 to 4 units, and you can potentially do non-mortgable condos with these. So again, a lot of options where this is going to fill a void to get someone into a home. Who cares if it's a 30-year fixed at 8% with a point? Who cares? The client's maybe they change up the way they pay their taxes. Maybe they get a new job. Maybe 5 years from now, they have a different income scenario, a different situation, and they're able to refinance into something better, right? Again, we're not talking hard money loans here. These aren't 14% with 3 points. These are reasonable loans that get people in a home. And what's their other option? Don't buy a home, go rent. By the way, Chris, Alec, what's the interest rate on rent?
100%.
100. Yeah. 100%. I told a client that the other day, like, 8% seems so high for this non-QM loan. I'm like, what's the interest rate on your rent? They're like, I don't know. I'm like, 100%. So, these aren't that bad. At this point in the show, I'm going to kick it over to our bearded friend, Mr. Alec Gagne.
Yes.
And he has the alternate color Ross Group hat on. He has the black and white version. I have the black and gray version. Chris is sporting the Ross Group polo. So we are in full effect today.
We are branded.
So I will go on mute here and I will kick it over to Alec.
Well, I was just going to say, if we ever do a training on service release premiums and selling loans in the secondary market, it very well could be the most boring topic of all time. But It is good to know what goes on post-closing. There's a lot of different things other than pre-approving a client, getting the home under contract, settling. There is a mountain of a list of other things to do after, the loan closes in, the secondary market and all that fun stuff. But that's besides the point. That's not going to help you get more deals right now. But what I will touch on is a product that I've actually used in the past with someone I know personally. And this is for people that have really good problems, which means they have a lot of money, right? In my scenario, and I'll read the challenge real quick. I just met an amazing lady who has $3.5 million in checking and another 1.5 in retirement. She does not have a job currently. That should not be a problem, right? It's not a problem. It's a good problem to have if you have that kind of money. In my scenario, I actually had a client reach out, and it's a kind of funny story because I used to park this gentleman's vehicle when I was a valet back in my day, and he reached out to me for a mortgage. He had recently sold a company, and he used to tip me $1 every time. And when I got to see his bank statements and his overall stock portfolio, it made a lot more sense to me. So in that scenario, I did use this asset utilization program, which is actually very generous when it comes to not only credit, but overall guidelines in and of itself. So we're going up to, 3 million in loan amounts, right? Loan to values up to 80%. So 20% down. Expect 20% down across the board for non-QM. And asset utilization is not different in any of that capacity. But this is also great because it allows you to purchase or refinance. So, let's say we get someone into this asset utilization program right now, and then in a year and a half or 2 years from now, rates drop, which we do anticipate, that's also eligible for a rate and term refinance. Now, the kicker is you're going to have to show a 6-month history of that money sitting in the account. So that's something we call seasoning. If you look at the qualified assets, if it's purely liquid in checking or savings or money market accounts, so you can use actually 100% of that. And then I'll show you what the algorithm is beneath that. But we have to discount stocks and bonds by 20% and retirement assets by 30%. If you look over on the right-hand side, this is actually, again, very generous when it comes to either a primary residence, second home, or an investment property. So again, it is a very flexible program, which a lot of, non-QMs are, and that's why they're engineered. But in this particular example of this amazing lady who has $3.5 million in checking account, we're going to take the $3.5 million in assets in that checking or savings account, and we divide it by 360. And that comes up with the qualifiable monthly income of $97.22. So that is the actual income we can put into the file based off of their assets and derive that to use qualifiable income towards your debt ratios. Okay. Challenge number 4, another amazing person. We only work with amazing people, but this is an amazing couple looking to buy their first home. They mentioned that they are non-US citizens, but they have an ITIN number. Solutions, we have one. Let's go to the next slide. Perfect. Yes, so that is an individual taxpayer identification number. That is what the acronym stands for. But the pure definition is this is something, it is a 9-digit code that the IRS comes directly from the IRS, and it has to come directly from them. These are people that, do not have social security numbers, and are technically not U.S. citizens. The purpose is, it's used by non-U.S. citizens, resident aliens for tax reporting and financial activities. So even if they're not a citizen, they're still working, making money, and they should be able to buy a home. So this is why that particular product exists. Already kind of touched on that. And Rob is flying through the slides here, but I'll push it over to Chris Carney.
Saving the best for last. Thank you so much. This last challenge that we have here for you guys is one that we're arguably using the most. It is extremely popular. We're talking about it a ton. So realtors, follow me on this one, because you've probably come across someone like this in your past that you thought was probably a waste of time. So imagine this: you meet a new investor client. They seem a little crazy because they have some really big ideas. I have an LLC. I want to buy 5 homes in 5 weeks. I want to do all these big things and be this huge real estate investor. You hear that and you think, okay, how realistic is this really? But if they have money, if they have the cash for the down payments, there's this next option that we're going to talk about could really be a great thing. And where this will make the most sense is if their income is challenging. I had someone who said, who I said, hey, what does your job look like or employment look like? They say, I'm a landlord. That's my job. So income may be a little challenging for that type of person. This loan is for investors. Investors, possibly you. Perfect line from Step Brothers on that one. Thank you so much. Think of these types of folks who this type of loan could potentially fit for investors. This is self-employed individuals, like a realtor or just a business owner in general. Serial investors. So again, like I mentioned at the beginning, someone who wants to buy all these properties and be a big time investor. Something that a lot of agents come across too is a client or a buyer who switched from being a salaried W-2 employee to now they own their own business, or they did a complete career change and they're business owners now with less than a 2-year work history. Usually, oh no, less than 2 years, that's an issue. You're not going to qualify. Well, we're going to get creative here. Or just business owners that have creative tax returns. Again, I'm winking at the realtors who sometimes can have creative tax returns between write-offs and everything else. This slide is extremely, extremely important for this program. So read it a couple times. But the first 2 bullet points here that we are pointing to with those arrows, they're the most important. So again, this is for investors, investor only. We don't need to have any information about income. No income whatsoever. Also, no employment history. So I'm going to say it again because of how important that is. No income, no employment, you guys. This is game changing. We don't need any documentation at all. No tax returns, no W-2s, no 1099s, no information about employment. It's really as simple as that. Now, what's the catch? Well, you do need to have money down. So usually it's somewhere around 20 to 30% that folks using this type of program need. So you do have to have funds. This is not a low down payment scenario. You do have to have 20% down or more. Credit scores are pretty generous, 660 and above. So pretty generous there. 1 to 4 units is the normal, but as Rob touched on in one of the beginning slides, we can actually use this program for up to a 9-unit building. So that's a relatively new change. But we can do up to 9 units. That you can't say that about any other program right now, which is huge. Another highlight, you can close in the name of an LLC. Almost all loan programs out there do not allow this, but this program does. So you can close in the name of an LLC. Gift funds, they are allowed. Again, not very common with investors, but you can have gift funds. The borrower or the buyer, they do need to have at least 10% of their own funds, but the rest, closing costs, the rest of the down payment, everything else, that can come from a gift. So that's important. One other highlight to make here is you don't need a lease. So even though a client is buying an investment property, you don't have to have a lease yet on the property that they're buying. Awesome. So how does it work? How do we qualify these people with no income and no employment and, not a whole lot of documentation needed from these people? How are we able to do it? We do it by the ratio. DSCR stands for debt service coverage ratio. So what we look at is the rent that the property is going to be receiving. We take the rent and we divide it by what the mortgage payment is going to be on the property. So this slide does a really great job of explaining everything and breaking it all down. Let's use extremely basic and easy numbers. So let's say a property is going to be receiving $1,000 a month in rent. The mortgage payment is going to be $1,000 a month. Again, we're dumbing this down slightly, but $1,000 in rent divided by $1,000 in mortgage, and what the mortgage payment is going to be is 1. Your ratio is 1. That means that the rent is covering the mortgage. When your ratio is 1, you qualify. And we're going to get into other examples of how we can be a little bit more creative with this too. So that's the formula that we use. Rent divided by what the mortgage payment is going to be. So we're basically qualifying the property almost more so than the actual individual buying it, right? So the numbers have to make sense. A couple other highlights here. We talked about the credit score. We talked about no income. Amazing. Usually 80% is the max LTV, which simply just means 20% down or more, right? Loan amounts are pretty generous. So this program ranges from about 100,000 up to 2 million. And again, it says 1 to 4 units on here, but there are flexibilities up to 9 units. This program is investment properties only. Something great to note here too, and Rob mentioned Deep Creek Lake earlier. For a market like a Deep Creek or a seasonal, type of community where they get seasonal rentals, this program can work there too, which is huge. So you don't need a 12-month lease or a long-term lease. This can be seasonal rental income producing properties. There is no limit on the number of properties either. One other thing too that is not on this slide, but is very, very worth mentioning, is you can get up to a 6% seller credit with this program. Any other investment property purchase is capped at 2% seller credit. This program can go up to 6%. Huge differentiator and something really good to make note of.
Great. Sorry if I missed you on this, but did you mention gift funds for DSCRs?
Yes, that was maybe on the slide right before this. Gift funds are allowed.
Perfect. I'd like to emphasize that because I'm having a challenge with a client on another investment property that's not DSCR, and we had to move to a DSCR. So
gift funds are allowed. We love that. Now, why are you guys so sweaty? Well, other than watching Cops, you may see the interest rate on these programs. Rates are going to be a little bit higher, right? I mean, there's no income, there's no employment. We're not really qualifying the individual and collecting a whole lot of data from them. So, the interest rates are going to be a little bit higher than, say, a traditional 30-year fixed conventional loan, right? So let's use an example because even though the rates can be a little bit higher, the alternative to this type of program is just a hard money loan or a commercial loan, and those rates are significantly higher and more expensive. So this is a really great alternative to a hard money or a commercial loan, which otherwise most people would have to get if this program didn't exist. So example one, let's use some real numbers here. So a single family purchase in the DC market, let's say it's an $800,000 sales price. This buyer has 30% down. So, well qualified there with the down payment. The interest rate for the DSCR program in this scenario is going to be around 8.875. There's a 1.75 point charge that goes along with this. Again, as a reference point, 8.875 with 1.75 points. That compared to a hard money or commercial loan is going to be, 14% with 3 points. So that, drastically better here. So back to the numbers. The monthly rent and this is an example that I used for a client a couple months back. The monthly rent on this property was going for about $5,400 a month, so $5,400 per month. Now, once you factor in the interest rate, the taxes, the insurance, everything on this property, the mortgage payment at the end of the day was going to be just a hair under $5,400. Okay, so again, we're kind of using an easy example here for you. The rent divided by the mortgage payment, they're the same. They cancel each other out. So your DSCR ratio is 1. Now, when your ratio is 1, pricing gets better, right? So that's why, you're below 9% in this example. Next example we'll look at will be a little bit different to show how this can be used in a little bit more of a creative way. So if investors find a property that doesn't cash flow or it doesn't break even, can they still use this program? And the answer, of course, is yes. And so here's an example that we can use. So again, remember, multi-units are good to go with this program. So this example is a 4-unit purchase, 4-unit property in Maryland. Sales price is $1.2 million. And the buyer has 25% down. When it's a multi-unit, usually 20% down isn't quite enough, and you need 25% or more when it's a multi-unit, for the most part, with this program specifically. Now, since it's a multi-unit, interest rates can be slightly higher. So in this example, you'll see the interest rate is 9.375% with 1.5 points. Again, compared to, hard money commercial, drastically better here. So each unit gets $2,000 a month in rent. So it's a 4-unit building. Total monthly rent for the 4-unit building is $8,000 per month. All right. Now, after factoring in the interest rate, taxes, insurance, everything that goes into this, the mortgage payment is actually higher than the rent that they're going to be receiving. Okay. So it's closer to $9,300 per month in the monthly mortgage expense. It doesn't cash flow. They don't cancel each other out. Does this deal make sense, right? It can, for an investor looking at this, you could look at, tax benefits. You could look at all kinds of different things as to why it makes sense. But this program works and allows this scenario to work as long as that ratio is at a 0.75 or higher, right? So if you take the rent, $8,000 a month, divided by the mortgage payment, $9,300 per month, That ratio is 0.86. So you are above 0.75, which means you are good to go with this program. So again, no income, no employment, property doesn't even have to break even or cash flow, and you can qualify for this investor special DSCR program. Pretty cool stuff. I don't say
Love it, Chris. Love it. You're right. The DSCR, it's not even close. We're seeing a significant, out of the non-QM suite of products, we are seeing more DSCR loans. I'm going to say 3 to 4-fold over other products. And not that there's anything wrong with the other products. It's just, it becomes more challenging to buy homes when you have that, as we said, crazy or amazing or whatever word you want to use, buyer that, and we get them. They'll call, hey, I was, given your number from so-and-so, and I own a primary right now, and I'm really interested in becoming an investor. I'd love to own 5 or 6 homes by the time I'm X age. And before, you're right, sometimes on the other line as a loan officer, we're like, here we go, this is going to be a challenge, right? Everyone thinks you can do all these loans, and they're not hard and whatever. We always knew when someone called with that question or that statement that there was going to be a debt to income ratio issue. It seemed inevitable. It was 90% of the deals couldn't qualify income wise, right? They didn't have a history. Well, this DSCR loan has changed the game for that. So one thing, Chris, and you might have mentioned this, and if you did, I apologize. I missed it there as I was monitoring the chat, but you have to own a home, right? And maybe we didn't talk about that. So to do it, you can't just be a first-time home buyer, don't own any real estate, and come in and say, I want to go buy 5 investment properties. You don't have to own a primary home. You could technically be renting a home right now. Just you're paying rent as your primary, but you own another investment property, right? Or the opposite. You don't own an investment property, but you own your own primary residence right now. But you do have to have property under management or on your credit report to do a DSCR loan. Is that correct, Chris?
Exactly right. Yes. First-time home buyers don't work for the DSCR program, or just if you don't currently own a property. You do have to own at least one home at the time to qualify.
Yep.
So, yes, and Michelle in the chat here was asking to go to this previous screen.
Yep. We're back there, Michelle. I saw that. And then we can also touch on the grant too. So
perfect.
Chris, do you want to take that grant question?
For sure. So, so Michelle, the $15,000 grant assistance. So it is available in April. So we're a few weeks away from that. Now that program, so ignore what's on your screen here. The $15,000 grant is for primary residents, first-time home buyers. So complete different end of the buyer spectrum with investors on the screen. And this is for first-time buyers. So you have to fall within a certain income threshold. So that's the big kicker with this grant program. You can use conventional, FHA, VA, you can use any loan program to acquire the home, but this $15,000 grant can help cover down payment, closing costs, escrow, everything. Just about everything. I think the buyer needs to come with at least $1,500 of their own money. Everything else can be covered by this grant. So you have to have a certain credit score, 640 and above. You have to be a first-time home buyer based on the size of your family. So if it's one person buying a home for themselves versus a family of 5 or 6, the income limits will vary according to family size. But if you meet those requirements, and we want to get those folks pre-approved now, ideally, right, before the funds are released in April, because the funds can go quick, over several weeks or a couple of months. But usually we find those funds go pretty quickly. So we evaluate this, Michelle, to put a long story short with this grant. When we pre-approve someone, we look at, of course, income, credit. We look at all these things, but if an individual or if a family fits this grant program, we talk about it, of course, and illustrate that to show what people can qualify for.
All right. Good stuff. Any other questions before we give you all 15 minutes of your day back here? And basically, we will get a copy of this presentation. We're going to upload this to YouTube, and we will get this sent over to you via email. We do have whoever registered. If you're on one of our other social media outlets, please just DM us or drop us your name and email in the chat, and we will make sure to get you the YouTube link to this video and also the very nice PDF that talks about seller concessions. Alec, Chris, we're going to have to dig that out and find out where we save that. I know we have it. We've used it a lot. It's a great tool. We do have Brian, Homberg, the GOAT. Brian's the GOAT. He's the greatest of all time. And don't let this guy rope you into a game of cornhole, though. He's deadly.
He'll crush you.
Can you do a lot or land loan option webinar on your YouTube that we can send out? Yeah, we can do that. We can talk about lot or land loans, but that will be more based around our construction lending webinar, which we already have slated and scheduled for a little later in the year. But we can do that. And we will definitely do that. Danielle, we will hook you up. Thanks for dropping your email in there. And we will make sure all the great folks at TaylorMade Real Estate get copies of all this. We appreciate your support. Any other questions?
Michelle had one last question. Can you get this in addition to other programs? Yes. So yes, you can. The $15,000 grant can be in addition to other programs that are out there. Yep, that's correct.
Perfect. Well, on that note, I think we're out of questions, and we will let everyone get a few minutes back. Thank you for joining us today. We appreciate your time and effort and support. And as always, we will sign off with the Ross Group at Intercoastal. We are working together to serve you better. And I got this new link here. Let's see. Can I play some music? Can we get some dance pop music as we're going out here? Ooh, there it is. All right, here we go.
Outro move is music.
That's how we're gonna end it from now on. Dance music. You don't want to dance off with the Ross Group. We will own that room.
All right, everybody. Thanks for signing on.
All right, see y'all. Take care. Bye.